This video is brought to you by NewsVoice. The news has broken. Almost all US media is owned by just a handful of big corporations. Also, fake news is a huge problem, and just finding something unbiased can be hard. NewsVoice is revolutionizing the news landscape. It's an app that gives you a personalized news feed by aggregating major news sites, as well as international and independent media, giving some much-needed balance. Each news story shows multiple sources, which are all tagged with their bias and perspective. The news affects almost everything in our daily lives. What we hear and read shapes which persons we trust, what we eat, what we buy, how we vote, even how we think. NewsVoice is created by its readers as you can upvote stories that you find interesting so more people will see them. It's essentially a democratized platform for the news. Plus, it saves you time. You get all the news and all the sources in one app so that you can stay better informed. And it's also totally free. Anyway, get started with NewsVoice today for free through the link below. It's available on both Google Play and the App Store. And let's get into it. During the first 3 months of 2020, the price of oil has plummeted by more than 60%. To give you an idea, at the time of making this video, the price of crude oil was at the same level it was in 2002. And as you might suspect, it's got a lot to do with the crisis unleashed by COVID-19, a virus that is turning much of the world's streets into something resembling the movie set from the film I Am Legend with Will Smith. At this very moment, in many countries around the world, mandatory quarantines are in place that are confining entire populations to their homes. This is the case in Spain, a country where restaurants, bars, hotels, shops of all kinds, and many offices and factories are closed. Clearly, all this is a major blow to economic activity. You want some examples? Well, keep on listening.
Unemployment could reach 30% in the US, says St. Louis Fed's Bullard. Coronavirus economic impact will be severe, at least as bad as Great Recession, says IMF. Volkswagen, Airbus halt European production amid wave of factory closures. As companies close plants, governments start rolling out financial aid for companies and workers.
The question is, what happens when the economy stops so abruptly? Obviously, demand for energy is reduced, and of course, if we're talking about energy and economics, crude oil is still king. It's the black blood that pumps through the veins of the global economy. So if, for example, planes hardly fly or traffic almost disappears because people are confined at home, oil consumption is obviously reduced. And that's exactly what's happening. Looking at its latest report for March, the International Energy Agency expects oil demand to shrink in 2020 for the first time since the major financial crisis of 2008. We only need to take a look at what has happened in China to understand what is going on in the oil market. During the month of February, when the Asian giant practically stopped its economy to take on COVID-19, China's demand for oil plummeted by more than 3 million barrels per day. And as containment measures are now spreading across the globe, oil consumption is also falling throughout the rest of the world. And of course, it's a simple supply and demand system. If demand falls and supply is maintained, then the price is reduced. Now, hold on a minute. Is that it? Is this what explains the enormous hit on the price of oil? Well, no, nothing is further from reality. Here begins a story that has all the makings of an international bestseller: Russia, Saudi Arabia, the White House, and a global pandemic. Maybe you've heard about the new oil war.
Putin and the fury of the Arab world.
A very important meeting was held in the Austrian capital on March the 6th. For those of you who don't know, Vienna is home to OPEC, the all-powerful oil cartel that brings together many of the world's largest crude oil producers. An organization that for the last 3 years has worked hand in hand with Russia to set its oil production levels, or rather to limit extraction and thus prevent oversupply from sinking pricing. It became known as OPEC+. The point is that on the 6th of March, OPEC proposed that Russia should carry out a further production cut of a total of 1.5 million barrels to try and stabilize prices in response to the impact of coronavirus. On this occasion, however, Russia, represented by its energy minister, Alexander Novak, said no, thus refusing to accept further cuts and breaking its oil alliance with Saudi Arabia. And that's where it all kicked off. The answer was unexpected. The Saudis took the nuclear option, in this case by flooding the market with much more and much cheaper oil. You see, after the failure to find agreement with Russia, the Saudi authorities announced a new strategy to increase its oil production by 25% to levels never seen before, 12.5 million barrels of oil per day. And they weren't the only ones. A short time later, the Emirates State Oil Company, the Abu Dhabi National Company, also said that it would raise its production to 4 million barrels. And for its part, Russia did not stay out of this race and soon announced that it could increase its production by 500,000 more barrels per day. More supply, less demand. On Monday, March the 9th, the oil price experienced a 24% drop, the biggest single-day crash in nearly 30 years. And just like that, a new oil war had begun. Of course, this whole race poses many dilemmas. Such a low price could create a huge hole in the public accounts of these two countries and many others besides.
OPEC and IEA warned developing countries could lose up to 85% of oil and gas income this year.
Countries such as Nigeria, Angola, Ecuador, and Mexico could have a very hard time, but even for some Persian Gulf countries, this whole thing could become a terrible headache.
Governments of more than a dozen oil-producing countries in Africa, Latin America, and poor countries in the Middle East won't be able to pay salaries of government employees by May if current low oil prices continue until then. Anas Al-Haji.
To give you an idea, in Oman, the public deficit could soar to above 20% of GDP. In Bahrain, government debt is going to far exceed the size of the entire national economy. And in Iraq, even the payroll of public employees, the country's largest workforce, is at risk. And let's not forget about the great empire, the United States, a country that in recent years has become the largest oil producer in the world thanks to a technique known as fracking. The problem, however, is that their producers are usually small. They are usually heavily indebted, and their extraction costs are higher than the price at which crude oil trades today. In other words, these low oil prices could lead to bankruptcy, and that could mean thousands, tens of thousands of layoffs, and may even become a stumbling block to Donald Trump's re-election. But at this point, the questions we can ask ourselves are, why has the Saudi kingdom launched itself into such a race? Why on earth did Russia say no to the cuts? How long will they be able to withstand this before the new strategy leads to the collapse of the public accounts in these two countries and loss of income in many other products? And what in heaven's name is going on with the US? Well, take a look at this.
Russia and its capacity to resist.
Let's be honest, the Russian economy is basically what is called a commodity exporting economy. About half of all Russian exports are oil or petroleum products, and along with gas, they account for 40% of government revenue. But hang on a minute, so why didn't they accept the cuts proposed by OPEC to stabilize the price of crude oil in the midst of the coronavirus crisis? Why did they break ranks and walk away from the table? I mean, what were they thinking? Well, on the one hand, there are a few who argue that this whole mess is nothing more than a kind of poker game between the Russians and the Arabs. Therefore, with its refusal to reduce oil production, Vladimir Putin's government might want to force the Arabs themselves to take on the crude oil cuts so that Russia could continue to sell its barrels at a higher price. Beyond that theory, however, the Russian oil bigwigs, such as Rosneft, Russia's great public oil company, have long called on the Kremlin to suspend its agreements with OPEC. Why? Well, because they consider that these kinds of agreements make no sense to Russian interests. That, on one hand, cutting production slows the development of new oil fields, while on the other, it means giving market share to the shale oil industry in the United States. In other words, OPEC-driven production costs would be fueling the American empire's oil rebirth. And of course, that's something that Vladimir Putin doesn't want. He doesn't like it at all. But the key question is, can the Russian government hold out long enough to drown US industry and get the Arabs to assume all the cuts on their own? Well, yes and no. Let me explain. On one hand, the Russian government only needs a little over $40 per barrel to balance its budget. This is far from the more than $80 required by the Saudi government. Moreover, in recent years, the Russian government has accumulated hundreds of billions in foreign reserves that it could now use to hold prices below $30 a barrel for quite some time. More than enough time to drown the fracking companies in the United States and force Riyadh to take action. On the other hand, however, it is also true that the Russian economy is not growing at all, that household incomes are now lower than they were 8 years ago, and that the current fall in oil revenues is going to make it worse. For example, do you remember all those big plans for new military equipment that Russia was bombarding us with over and over again? Well, they've been filed away. So that's the Russian position. But what about Saudi Arabia? Why did they suddenly go from wanting to cut production to flooding the market? Well, take a look at this.
Mohammed bin Salman's Plan B.
The truth is that this is not the first time Saudi Arabia has used a price war to try to punish its rivals. The problem is that so far, these kind of strategies have always failed. In the 1980s, they used a price war to try and sink North Sea producers, and just a few years ago in 2014, they repeated the move to try to drive US fracking companies out of the market. They weren't able to do it. To give you an idea of what we're talking about, according to data from the International Energy Agency, this strategy cost OPEC countries more than $450 billion in just the 2 years it was in force. $450 billion. But hang on a minute. Over the last few years, some things have changed. And as you'll see, Saudi Arabia is not only one of the world's largest crude oil producers, but also one of the biggest oil consumers, specifically the 5th largest consumer of black gold on the planet. It sounds crazy, but every year Saudi Arabia consumes more oil than countries like Germany or the UK. In fact, although it's hard to believe, it consumes almost as much as Japan. It is precisely for this reason that the Saudi government has put some measures on the table to reduce its consumption and so release more oil to export. For example, they are investing a lot of resources to double their natural gas production within a few years and completely replace oil in electricity production. They are also reducing petrol subsidies and implementing a lot of energy-efficient plans. Thus, between increased production and lower domestic consumption, the Saudi government hopes to have the capacity to increase its crude oil exports by more than 40%. And this is precisely what could allow the Saudis to launch what is known as a rapid monetization strategy. That is, take advantage of its extraction costs. Saudi Arabia has the lowest extraction costs in the world to increase its market share and drive out many competitors. Thus, increased market share could not only more than offset lower prices by increasing the Saudi kingdom's revenues, but these lower prices would also help slow down the arrival of technologies such as electronic cars. It is something that Riyadh has been considering for years, and now Russia's banging on the table could have pushed them into this change of strategy. Of course, all this works in theory. In practice, the problem is that in the short term, public accounts can suffer greatly. This will compromise resources needed to carry out their Vision 2030 diversification plan, and it is not even clear that the new competitors would disappear altogether. And believe me when I say this, there's nothing that scares the Arab world more than watching their vast reserves of money dwindle year after year. So the truth is that if there were an agreement, the Saudis would be much more comfortable continuing on as they did before. Of course, if that's not possible, there is always Plan B. And that takes us straight to the United States.
On the ropes.
In recent years, the United States has seen its oil industry reborn to the point of becoming the world's largest producer of black gold, all thanks to fracking. The problem, however, is that the extraction costs of fracking companies are much higher than the cost of extraction from countries like Saudi Arabia. We're talking about a difference that can, in some cases, be almost $40 a barrel. And of course, with prices in the region of $25 a barrel, the numbers do not add up. And that is precisely what explains news stories like this.
7 of the most prolific Texas shale drillers cut $7.6 billion from budgets as oil prices collapse.
But this is just the beginning. The oil industry has become one of the main engines of the US economy.
The golden era of American energy is now underway.
In fact, in recent years, it has been responsible for the creation of tens and tens of thousands of jobs and at least 10% of all economic growth. And now, because of this war, much of that immense wealth is in jeopardy, and with it is President Trump's own re-election. The situation is so serious that the White House is even considering two scenarios that until a few weeks ago would have been unthinkable. The first is that they are threatening to impose tariffs on oil from Saudi Arabia and other OPEC countries in order to match their selling price to what local producers need to make. The second move, as published in the Wall Street Journal, is the State Department has raised pressure on Saudi Arabia to withdraw from OPEC and reach a full agreement with the United States. In that case, we would be talking about a virtually unlimited alliance between the two countries, an alliance stronger than the bond between the United States and Israel.
President of the United States is the President of the United States. He can do whatever he wishes, and he's not certainly accountable to me. However, the US is a strategic partner.
Anyway, this is the new oil war that the coronavirus has unleashed, a war that leaves us with many questions. Will Russia and Saudi Arabia end up agreeing, hence returning to the former status quo? Will we be seeing the beginning of a new era in the world of energy? How long will Saudi Arabia be able to withstand such low prices? Well, leave your answer in the comments below. Also, please do check out our fantastic sponsor for this episode, News Voice, and thank you for watching.
And if you want to learn more about politics and hear even more of my lovely voice, you can join us at Reconsider Media. We have a podcast at reconsidermedia.com/podcast. See you there.